Investing in the stock market can give you excellent returns, but for a lot of people, this is really the best route and long term when it comes to investing. But investing can also be very scary and intimidating, especially first time investors if they're not familiar with what they're buying. Stocks, bonds, ETFs, shorts. There are so many things out there to really invest in that it can be confusing, which is why we're going to go through the best investments as a beginner. If you're just starting out, if you're younger, let's say just starting your first job, starting to have a regular income, the best investments to really start with our first one, which is a high yield savings account. Now, of course, high yield savings accounts used to be kind of a thing of the past. We have seen a massive resurgence when it comes to these high yield savings accounts. I even personally use M1 Finance. They have a cash account. There's a link down below, but it offers a 5% return. That is right. We are seeing a higher return than pretty much savings accounts that I have seen anywhere, even beating out a lot of term CDs that I have seen at a 5% return in there. Now, the high yield savings account, of course, is going to give you liquidity to all your assets, meaning you're going to have full availability to that, making sure it's really insured through the FDIC or the NCUA, depending on where you're keeping this money, and also know if there are any caveats. Now, with lenders out there and with some financial institutions, you have to know the ins and outs. Sometimes they require a minimum balance to get the rate. Sometimes they also have maintenance fees if you don't have enough money in there. So definitely make sure you check everything. Now, number two, we get into the 401k. When it comes to employers, this is the most traditional thing that we see when it comes to retirement planning. With a benefit package and working at a company, they do offer a 401k. Now, a lot of companies do offer a 401k match globally or really within the United States. Their average is about 5%, which is what they match. You have to make sure, number one, that you're getting this match that you're putting in there. And number two, that you're putting money in there. We have a lot of 401k matches that we see that go really without being touched at all. Now, when it comes to the 401k, most companies do have two different options. You either have a traditional 401k, which is going to give you a pre-tax contributions, or some companies, including mine, have a Roth 401k, which are essentially taxed up front, but in the future, you won't have to pay taxes in a retirement age. Now, out of these two, as a financial counselor, the best way to look at this, guys, is if you're doing a traditional 401k, you are kicking your tax burden down the road to the point of retirement when you're going to have to pay it. And chances are when you get into retirement, you're going to have a very, very large sum of money in this 401k, meaning that you could actually pay a lot more taxes when you're retired, even though your income is lower because of the money you have to take with the required minimum distributions out of the 401k at a certain age. This is the reason why 100% I recommend, without a doubt, hands down, doing the Roth variation or the Roth 401k. Pay the taxes up front. You'll thank me later, because essentially there's going to be a point down the road where when you need this money, it is 100% tax-free. You're not going to have to worry about it. You are also not going to have to worry about it boosting up essentially the earned income that you have if you have to take a larger withdrawal out of your 401k once you reach retirement age, once you're at that stage. Now, in addition, there's a SEP IRA, there's a simple IRA, the simple 401k, solo 401k. There's a lot of different variations out there, really depending on what you're looking at. So do your research, make sure you know exactly what you're getting into. The number three in this list is our short-term CDs. Now, short-term CD to me is about 12 months or less, would be what I'd say general rule of thumb, short-term CDs. Now, these are term deposits. Now, traditionally, term deposits, if you're doing CDs, the lower term, so essentially the 9 months, the 11 months, the 12 months, as of right now, are paying considerably more than the 3 years, the 4 years, the 5 years. This is because of the inverted yield curve. And overall, when you start looking at some of the best CD rates in the nation, they're about 3.25, 3.5 you might find somewhere. But also remember that that high yield savings account is still yielding you 5% as well, which means you do also have to know the in and outs of these CDs. Because again, if you break the CD terms early, a lot of times you can forfeit some of your earnings. And if you break it really early in the term, you could even forfeit some of your initial deposit that you did put in the CD, which is the reason why you really have to know where your money is going. Is it short term? Is it longer term? Is it retirement? Is it going on vacation? What is the money going to be used for? This is why the financial plan is super important before you start down this investment road. Number four, we look at the MMAs or the money market accounts. This is another type. So this is actually a checking account, or it can be a savings account that has the ability to work as a debit account or as a checking account. Now, a lot of money markets that I see don't function, or they're pretty limited in the capabilities that you have them. Traditionally, what I've seen through my career in financial institutions is money market accounts don't really have much of a benefit. It's a lot better to do a checking and a high yield savings, or do a checking account and CDs, because you get a much higher rate. Even looking at the money markets that currently offered around here, financial institutions are about a 0.3 to a 0.5%. Where again, when you look at high yield savings, you're at 5. When you look at CDs, you're at 5 plus. Really beneficial. But again, look at money markets, because some of them do have a pretty good return. Now, in addition, there are a lot of institutions, including a local credit union here, that offers 5.25 on a checking account up to the first, I believe it is $7,500. So you have to know the incentives, you have to know the plans, really understanding the in and outs of how you can get in here and what is going to be the most when you're parking your money in financial institutions. Number 5, we get into the mutual funds. Now, rather than putting your money into individual funds, this is where mutual funds come in. This is where index funds comes in. This really helps you diversify all of your investments, making sure that you're not going in and buying one specific company, which again, I do not recommend investing in one specific company. Even if you want to get into mutual funds and you want to be very, very streamlined, let's say you only want to go into a tech mutual fund, you can find exactly what you're looking for. And there are a lot of mutual funds out there that you can go ahead and shop, know and do your research and know exactly what you're investing in, what companies it's going to be in. But again, this can really diversify, because instead of holding one company, some of these ETFs can hold hundreds, even thousands or tens of thousands of stocks, and again, individual companies within mutual funds itself. Now, the big thing with mutual funds is they are managed. So most of the mutual funds are managed. Managed funds come with a significant fee, usually a percent and a half if you're paying a financial advisor to go ahead and do the mutual funds. How they're run, again, mutual funds, even though they're managed, a lot of people say they should, and most of them do not outperform when we look at number 6, which is our index funds. Now, for me personally, I go into these index funds. They are ones like the VOO, the Vanguard S&P 500, that actually track the S&P 500 index, which essentially you're betting in the 500 largest companies in the United States. Now, when you look at this index fund, and again, going into like the S&P 500, the Russell 2000, the 3000, whatever it may be, index funds track a very specific index, and they kind of run hand in hand with it. But of course, looking at something like the VOO, which does track that S&P 500 index, we are looking about an average of a 10% return that we have seen in here. So when you think high yield savings, 5%, CD, roughly 5%, a lot of other things a lot lower, especially when you get in mutual funds that could have a higher fee associated with them. If you're putting money into the S&P 500, which of course the most famous investor, in my opinion, that I absolutely love, Warren Buffett, says everybody should own the S&P 500. They should own the VOO. That way they can get not only a super low yield, really ETF within there, but they're tracking the index, and the index historically has performed exceptionally well. Number 7, we get into my bread and butter, which is the exchange traded funds, or the ETFs. These are ones, again, that take a group of stocks, puts them into an exchange traded fund, kind of pooling them together, again, mitigating your risk and making sure instead of owning those individual stocks that you are owning big groups of stocks. Now, ETFs are traditionally a lot cheaper and managed than mutual funds. Some brokerage firms even offer them at 0% commission. And again, plug for M1 Finance down below, guys. They do offer an incredible amount of lineups of ETFs, mutual funds, all of that. And of course, there is no commission to go ahead and trade those. Now, of course, if you like the content that I'm throwing out there, go ahead and subscribe to the channel, and we'll get into our final one, which is number 8, individualized stocks. Investing in individual stocks, and this comes with some caveat, can be very risky, but there can also be a big return or a payoff in the long run. If, again, probably about 12 to 18 months, if you would have invested into NVIDIA, you would have done exceptionally well for yourself. But on the flip side, if you would have just invested in Tesla, chances are you'd be down a considerable amount within a year later. So this is where a lot of the risk mitigation comes with the exchange traded funds and with those index funds, making sure again that you're invested not only in all of the sectors of the market, but also in all of the companies that are encased within those sectors. Now, again, stocks, I do not recommend. It is buying ownership and buying stake in a specific business. Purchasing stock at the right time, you could make some money. But again, most of the stocks, if you're going in as a stock trader, you're going to have to follow the news on the companies. You're going to have to follow exactly the up and downs of the companies, or you could see a lot of volatility. And of course, we've seen a lot of companies that are doing not very well that have been kind of through the last couple of years, keep filing bankruptcy kind of on a regular time. Now, of course, if you're going in here and you're buying some of the highly decorated companies that have been around for, 40, 50, 60, 100 years, chances are the stock is still going to be there. There's going to be ups and downs, of course, with this, but that is where, again, I mitigate my risk with my ETFs, and that is how I do my investing. All right, guys, so that is going to do it for today's best investments for beginners. Let me know in the comments what you guys think, and as always, thank you guys for watching.